and gentlemen, good day and welcome to Sterling Tools Limited Q2 and H1 FY24 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Pankaj Gupta, Group CFO, Sterling Tools Limited. Thank you, and over to you, sir.
Thank you. Good morning, everyone. On behalf of STL Group, I extend a warm welcome to our Quarter 2 and H1 FY24 earnings call. I'm joined on this call by Mr. Atul Agrawal, our whole-time director, Mr. Jaideep Wadhwa, director, and SGA, our investor relation advisor. We have uploaded our results presentation on the exchange, and I hope everyone has had a chance to go through the same. I will now request Mr. Atul Agrawal for his remarks.
Good morning, everybody. Thank you, Pankaj. I welcome you all to a Q2 and H1 FY24 earnings call. Let me just dive in directly into some broad industry numbers. As you guys are probably more informed than us, the industry numbers are looking a little tepid. The industry overall, automotive industry overall, grew by 1%. And the bulk of the growth, even though that 1%, came from passenger vehicles, which grew about 15%, driven by a change in buying patterns, preferring more SUVs and bigger vehicles. Two-wheel industry has grown pretty much flat. It's only about 2.2% up. Commercial vehicles are up 3.6%, and farm equipment is negative 8.7%. So overall industry is probably up only 1%. We at Sterling Tools, we are up close to 4% in revenue in our standalone business, and overall we are up about 23% on a consolidated level. Talking about electric vehicles, which is where we are focusing a lot of our business, that industry has grown by 37%. It is below our expectations, and I think the FAME 2 subsidy amendments and changes have caused a temporary hiccup in the growth numbers. But our subsidiary at SGM level, we are up about 111% in revenue in that business. So despite the hiccups, I think we are still clocking a good growth in that number. The only concern being the core automotive industry, which, like I said, is up 1%. But we are still outpacing that industry in our growth by 4%. It is not a number we are happy with, but we are making some efforts to grow much faster than the industry is growing right now. Coming to other updates, the company is introducing an STL ESOP plan 2023, wherein the company shall grant ESOP subject to regulatory approvals. The ESOP plan is being introduced with a view to provide employees of the company and its subsidiaries employees with additional incentives based on productivity and performance, and thereby motivating them to contribute further to the corporate growth and profitability. We at Sterling Tools, we are committed to deliver sustainable growth and strive towards outpacing industry growth at standalone and consolidated level. Our primary objective is to boost capacity utilization, which in turn will empower the company to attain operational leverage. We are diligently implementing a three-pronged strategy of customer acquisition, higher content per vehicle, and development of new products. We have uploaded the presentation on requisite portals, which was done yesterday. I'm sure you will have the chance to review those numbers. We're not going to dive into a lot of data in this call because it becomes a lot of verbal data, which is difficult to follow at times. You have hard numbers with you. So may I suggest we dive into the Q&A directly and take it forward from here. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone participant present on the audio bridge who wish to ask a question may press star and one on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and two. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants who wishes to ask questions may please press star and one on their touchtone phone. We'll take the first question from the line of Abhishek from Dolat Capital. Please go ahead.
Thanks for the opportunity, sir. Sir, my first question is on fastener business. As the raw materials prices are benign, and it was expected a sharp jump in your fastener business margin, while margin still is hovering at a 13.5 to 14%. So when can we expect a historical margin of 16 to 17% in the fastener business, sir?
So, good morning, Abhishek. How are you? It's been a long time we spoke. Abhishek, so just two data points on that. Yes, steel is, I would say soft. It's not soft, but at the same time, it's not. Steel is not as volatile as it was, say, 6 months to 12 months ago. So that's a good sign for our business. There's less volatility. Our raw material content is currently at 42-43%. Yes, you're right. Historically, it is at 39-40%, and we hopefully will get there in times to come. But I think our historical margin was 16-17%, and we have raised this issue earlier as well. One, there's that customers have compensated us for the steel price increases, but we haven't got full compensation for the conversion or the value addition we do for our product in our shop floors. So we have not been compensated for other inflationary pressures on petroleum products, chemicals, energy, people, etc. So that's putting that pressure on margin structures. Having said that, our margins on a standalone basis in a fastener business have improved. I think we are on a half-yearly basis. We are at 14.4%, which was for the quarters at 14.6, vis-a-vis the Q1 at 14.1%. So there is a margin improvement happening in our EBITDA margins, and we hope to see that improvement continuing in the third and the fourth quarter as well. It's also on the function of the count fact, that we are, as the prices of raw material are softening, we still have some old inventories at higher price points in our system, which will get liquidated over time, and the new inventories will start getting activated, which are already getting activated, which will help us improve our margin structures. So we are hoping that our margins in the coming second half will be close to 15%, giving us an overall margin in our fastener business close to 15% or 14.75 and 14.8%. That's our estimation on the margins for that business.
Okay, sir. Sir, and a second, in the MCU business, despite the fall in the revenue, your margin remained strong at around 7%. So how is the outlook of the business for this, and what is the outlook of margin as well?
I'm going to let Jaideep take questions on the EV side. Jaideep, over to you.
So in our SCM subsidiary, we've indicated that we believe that our margin percentage should be between 7 and 9%. We have, because of the fact that we are not a very asset-heavy business, we are an asset-light business. We are a high working capital business. So volume leverage does not give us such a big impact on our margins. We've said this before, and I'll reiterate that we believe that the steady-state margin for this business will be about 7 to 9%, unless we do further investments for putting up SMT lines, etc., and bringing some processes in-house, which is not something which is in the plan for this year.
So, in a non-fastener business, you had guided around double revenue in FY24. In first half, revenue is muted. So still you intact your guidance given the slowdown in the e-two-wheelers volume post FAME subsidy reduction?
Yeah, well, so I'll like to put in a couple of points here. Definitely, the sales of e-two-wheelers has not been as per our expectations, and government policy changes have had a big impact on this. So, we do see that doubling our growth or doubling our numbers from last year is going to be a big challenge. We still believe that we'll have very, very strong growth year over year, but it will not be 2x as we had projected at the start of the year. I think another interesting data point which was there in today's newspapers is that the top 4 companies in the electric two-wheeler space now control 90% of the market. That means Ola, Ather, TVS and Bajaj now have 90% market share. For us, the good news is that we have at least one of those as our customers. The bad news is that some of our other customers that we had a lot of expectations from are not doing so well against the big 4. So yes, we'll have to see how this maps out over the coming months. The other thing I would mention is that we continue to improve our position in the three-wheeler and LCV space, and that should also continue to add to our revenue. So I don't think we'll be able to get to 2x, but I do hope that we'll be able to put in a strong performance in terms of revenue growth.
So as you mentioned that the top 4 players are having the 90% market share. So in terms of the incumbent like TVS and Bajaj, how is your market share? Or are you looking to start supply to them?
We are, as I mentioned, we are in touch. We have had discussions with nearly all of the auto companies at one stage or another, but Bajaj and TVS, those 2 companies specifically, are not our customers as of today.
Okay. And my last question on the in LCV segment, you are going to start supply MCUs even in the three-wheelers, and most of the companies are coming with the three-wheelers, EV three-wheelers and LCVs as well. So how is the progress now in that part?
So, I think the big event for the industry was on 11th September when Ashok Leyland and Switch Mobility showcased their new vehicles and they launched the Dost and the Bada Dost. And I think that's not only important from the fact that these 2 products were launched, but it's important because it galvanizes everyone else in the industry to speed up their product launches. So we see a lot more activity from the other companies also to bring out their products, because I think that obviously when a very strong OE like Ashok Leyland / Switch launches a product, then other companies would not want to be left behind and will work hard to think. So we are very hopeful we have very big hopes from the LCV business in FY25.
Thank you, sir. That's all from my side.
Thank you. We'll take the next question from the line of CA Nihar Shah from Crown Capital. Please go ahead.
Hello, sir. Good morning.
Good morning.
Yeah, I have just 2 small questions. One is that we are planning capacity expansion for SGEM, I guess. So what will be the capex coming in H2, and what was the capex we did in H1 this year?
Okay. So if you're waiting for me to, would you like to ask your second question also? Would you like me to address this first?
Yeah, let's do it question by question. It would be.
So our capex plan for this year was 28 crores.
Okay.
And for various reasons, the first half has been quite light. It's been about 5 crores. But I still believe that we are on track, we will see our expansion coming through within this year. So I do expect to be able to invest the balance 23 before 31st March.
Hello.
Yeah. Could you hear me?
Yeah.
Yeah. So just to give you to just summarize that for you, the capex plan was 28 crores. As per current expectations, we expect to complete that capex plan before 31st March.
Okay. And one small other question is it's relating to the top line. Our top line saw decline on quarter-on-quarter basis. So how are we planning to grow from here? What will be the drivers for our growth in H2 and coming FY25-26?
So I think there were a couple of there are obviously a couple of reasons for the decline from H1, so from quarter 1 to quarter 2. One obviously being the change in policy, which means that a lot of the customers a lot of our customers, a lot of the OEs have had to rejig their product strategy because the incentive, the FAME incentive was based on the size of the battery pack. What these companies are doing is to reduce the size of the battery pack, which is also the largest cost component in a vehicle, to minimize, to make the product more cost effective. So yes, there is a timing lag that we can see, or we are seeing a temporary dip, but it's not. To my mind, it's temporary for sure. It's not permanent. It's just a matter of realignment of product strategies by our customers. The other thing to keep in mind is that the numbers in May were totally unrealistic. There was a lot of buying that happened in May, driven entirely by the fact that the duty was being the FAME subsidy was being eliminated. So if you take out the impact, and if I remember correctly, the May was about 40,000 units, approximately that number, higher than the average. So if you take 40,000 units and spread that out over a quarter, you'll see that quarter 2 for the industry as a whole was not hugely off. So I think the industry will weather this temporary setback. And as far as SGM is concerned, we've talked about our strategy very extensively. That it's not only about the E2-wheeler, but also the 3-wheelers and the LCVs that we are counting on for our future growth.
Okay. Thank you, sir. And one last question is do we have any major orders under our subsidiary SGM? We have 16 contracts, if I'm not mistaken. Have we gotten any other contracts? And what will be the timeline for completing this contract?
So, look, we have a lot of contracts. The challenge is that if our customers don't, if their vehicles launches are delayed or their volumes are not in line with what they expected, the contract is not, it doesn't help that much. So we look at it more from the aspect of, the fact that we are there, we are 100% of the business. And as these companies ramp up their production, that we will continue to get it. I think maybe you're looking for an indication of where we are heading. I think in the first question I mentioned that we feel that we'll do well overall. We are at 130 crores approximately in the first half of this year. That takes us to 260 for the full year if we can maintain this run rate. I believe that we will maintain and improve on this run rate for sure.
I'll get back in line for another question. Thank you.
Thank you. A reminder to all the participants, anyone who wishes to ask questions may please press star and 1. We'll take the next question from the line of Kevin Shah from Fin Avenue Growth Fund. Please go ahead.
Hi, good morning, and thank you for taking my question. I'd just like to know the current capacity utilization levels in the standalone business and also in the MCU segment as well.
Good morning, Kevin. So let me talk about the standalone business. I think we currently at a run rate of maybe let's say 5% growth. We'll probably clock 600 crores of revenue last year. On a full utilization basis, we should probably clock a revenue of between 800 to 850 crores in all our capacities put together based on our current product mix and current price points. So that gives you a sense how much headroom we have for growth with the current capex in place.
Okay. In our SGM subsidiary, Sterling GTech subsidiary, we've already ramped up the capacity to about 1,500 units per day, and assuming 90% utilization or 90% being the optimal, we actually hit that number on a very often. But if you looked at it over a period of a month or so, our capacity utilization would be about 70%. But this business, you know the fluctuations in the market, so we track it daily because that's how it tracks. But I mean, I think to answer your question directly, we're averaging about 70% on current capacity, and then we hope to expand that capacity, in the coming months.
Okay, thank you. And just on the back of the point of capacity expansion, in the MCU business, we were looking to expand our capacity to about 6 lakh units. So is that expansion plan still as per schedule? Like, is it on track as per our thought process?
Yes, it is. And I think I'd also explained that in the last question that in terms of our capex, we expect to utilize the entire budget of 28 crores by 31st March.
Okay, sir. And just one last question. In the previous call, you had mentioned that you all will be finalizing the terms of your agreement with GTech, like you'll be meeting them. So is there any update on that? Are those terms crystallized? Are we through with that?
So, no, the meeting has not happened yet. The meeting is now scheduled for later in this month. And I am very confident that we'll be able to announce the finalization of this definitely in the next call or earlier.
Oh, okay, sir. And just one last question, if I may. Do you expect the second half of this year to be slightly more positive, driven by like the festive seasons coming up and just like a general bounce back in demand? Like you're even in the two-wheeler segment for the MCU business and even for our fasteners business. If you could just throw some light on that, sir.
Can you repeat that question again?
Festive demand in the last quarter.
Do you expect the second half of this year to have like a more positive response in terms of sales in comparison to the first half of this financial year for both the businesses?
So the festive sales are pretty good, but you also got to keep in mind that upsurge happens in production levels with OEMs a month before the festive season starts, which is probably September, October this year. So the production numbers are pretty strong all around. Now, having said that, the month of December is pretty slow for various reasons. One, there's a lot of demand which has been satisfied during the festive period. B, a lot of the OEMs going for a shutdown mode for short periods, some as small as 5 days, some as long as 14 days for maintenance and an annual shutdowns, which from our perspective, from a consumption perspective or a production perspective, slows things down. So, but that's an annual cycle which happens every year, and it's been happening for a while.
I think Atul's addressed the macro, macro industry trend. But I'll just add to that in the EV space, the other thing that we are looking at to help boost our numbers is new product launches by our customers.
Okay. Thank you so much, and all the best for the months ahead.
Thank you.
Thank you. We'll take the next question from the line of Dushyant Mishra from Sage One. Please go ahead.
Hi, good morning, everybody. I just had a quick question. Jerry, you kind of alluded to the fact that it's better to work with all sort of participants.
I'm sorry to interrupt, sir. Mr. Mishra, your audio is not that clear, sir. May we request you to use your handset, please?
Okay. Is this any better?
Yes, sir. Please proceed.
Okay, great. Jerry, you've alluded to the fact that it's better to work with a basket of sort of EV manufacturers in the past, so that whoever the consolidation eventually leads to, you still have a horse in that race. But it seems like 50% of the leaders today, we have absolutely no exposure to. Is there a strategy to change that? And despite what you're talking about with sort of customers' new product launches, is there anything at our end in terms of new product innovation outside of the MCU space, within mobility, obviously, that we would want to ramp up to increase our wallet share within them?
I'd just like to clarify my statement from earlier. When we talk about a basket of customers, we're talking about customers from the established OEs or the incumbents, and as well as working with certain startups, because we do believe that some of the startups will have the ability, or at least potential, to disrupt the industry in some way or shape or form. So our idea, when I talk about that, it's about saying that we try and work with as many companies as possible. We are constantly in touch with all of the OEs and trying to figure out how best we can serve their requirements. There is a constantly changing dynamic around this as new models are launched, as new strategies are developed, etc. So we continue to look at customer diversification and having a broad customer base as a key element of our strategy. Having said that, it's unlikely that we will ever have all of the customers, all of the companies as our customers. And if you look at the auto industry, in India and globally, no tier ones really do that. Tier ones typically have some level of concentration with some OEs. So I hope that addresses your question there. Regarding our models, we continue to launch new models. When we continue to bring new products into play, and I've also mentioned that before the end of this year, we do hope to have some additional products that we will be launching. So we in the motor control in our subsidiary, in our Sterling G-Tech subsidiary, we hope to have greater share in the MCU business, in the motor control unit business or the MCU business, and we also hope to have a greater share of wallet overall by introducing new products.
Got it. If I could just go back to that first question, what is the trigger for our current, for example, the guys that we don't work with, who make up a lion's share of the EVs out there? What is the trigger for them to introduce or use us in some of their other models that they launch? What is that business development like? What do you approach them with as a proposition relative to their current suppliers?
Yeah. Well, I just, if I may, can I just say that we do work with a lion's share of the industry. We work with, so we have, in the two-wheeler space, we have over 40% market share. So, I'd just like to correct that. In terms of the trigger, it's, as of now, the industry still does not have dual sourcing as a strategy. It's typically a single source strategy. So our trigger typically is when a company looks at launching a new model. Let's say and I'll just talk about a customer that currently doesn't buy from us today. So we would want to to pitch for new models as they are launched, and that process starts at least a year, possibly more, in advance of the launch of the vehicle. And so we start working with their engineering department to do trials. If we get selected in that phase of initial trials, then we have to work very closely with their teams on vehicle integration and so on and so forth. But today the trigger is typically when a customer says, I need to have a new model. Recently you've seen, and I also mentioned this earlier, that instead of having 4 kilowatt-hour battery packs, the companies are now looking at smaller battery packs in the 2 and 3 kilowatt-hour range. Therefore, they need smaller motors and smaller motor control units because they don't want to draw that much current from the battery packs. So as they make their product strategy, then that's when we start working. Did I address your question?
That did. And one last thing. So is there something on the anvil right now? Because you say you have about a year's worth of visibility in your product launches. Is there something in the next year that's giving you the confidence of the growth that you're talking about? Or is it mostly on the current customers that you're working with that you're basing this off of?
So, when we've kind of resisted the whole notion of talking about an order book, because we find that to be, as I explained a little earlier, that it's a little nebulous because of the fact that we don't know exactly how the launches will go and what the success of the launch will be. But what we do track is what is the number of customers that we have who have given us a contract, who have sent their vehicles into homologation with our product. That number today is 16. The number of vehicles within that, I think, will be closer to about 20. Now, not all of those are, in high production volume. Some of them are, still in homologation. Some are still, some are doing trial marketing in one city or 2 cities or something like that. So there is that those 16 contracts that we keep talking about is what our pipeline is. In addition to that, we have, I'm going to say, another 10. Let me back off. So the numbers that I track are 16 active customer contracts, 40 engagements with customers. That means there are 40 other customers that we are working with. And of the 40 that we are working with, 10 are in an advanced stage where we've got a lot of interactions, where we feel we're in the right ballpark in terms of product performance and pricing, etc. So we don't have the contracts, but we think we're definitely amongst the short list. So that's the pipeline that we track, and that's what gives us the confidence for growth.
Understood. Makes sense. And my last question is on the fastener business. I mean, we're doing about a 50 crores per month sort of run rate. How many months of high-cost inventory are we still sitting on?
I think on an average, if you see our inventory carrying days is about 120. So that gives you a sense as to where we are on that high-cost inventory. And
probably expect another quarter of lower gross margin than what.
Since we carry a lot of grade of products, a lot of variety of SKUs, so some have already been consumed, some are not. So there's no thumb rule to it. But I think on a full cycle, it takes about 3 to 4 months to exhaust that.
Perfect. Thank you so much, Atul. Thanks.
Thank you.
Thank you. We'll take the next question from the line of Kush Kusrani from Incred Asset Management. Please go ahead.
Yeah, hi, sir. Good morning. Am I audible?
Yes, you are. But if you could get slightly closer, that would be helpful. Slightly closer to the mic.
Is it better now?
Oh, much better.
Yeah. Sir, I am new to your company in terms of understanding, so if you could help me cover my knowledge gap. In the MCU business as of now, how is the position with the partner? Have they invested or are we just buying from them right now?
In our Sterling GTech subsidiary, we do not have investment from GTech. That was, as you're aware, the government has restrictions on investments from neighboring countries. So the agreement has been morphed into a technical agreement, which I think we just discussed a little while earlier. We are in the process of fine-tuning that, fine-tuning the arrangements, and we'll be able to sign that within this month.
Sure. And if that happens, then there would be no need to pay royalties to them, per se.
So, I think what we said is that our costing will not change, so our gross margin will not change.
Sure.
So that's what we see as our sustainable margin will not be impacted by our technology agreement.
Sure. And then we would have to pay minority interest, that is when we report numbers, right? My understanding is right?
I'm not sure I understand your question. Could you repeat that, please? Maybe I'll get...
So the subsidiary profits would be shared with GT as well, right? Once they acquire...
No. There is no... Because they don't have a minority investment, right? That's
right. Once the investment happens, whenever it happens... I think other than the political leadership of this country, I think no one else knows when that will happen. So there is until there is clarity there, we have no way of knowing if it will happen. And I mean, the question now is that considering we've been working with them now for over 2 years, on this other arrangement, which we keep adapting as per the things we feel that I'm not sure that there is value for us to have an investment. Got it, sir. That's thank you for clearing my understanding. I'll get back in it. Thank you.
Thank you. We'll take the next question from the line of Sonal Gupta from HSBC Mutual Fund. Please go ahead.
Hi, good morning, and thanks for taking my question. Atul, I just wanted to understand, right, like like you mentioned that our capacity on the fastener side is to get to a turnover of about 850 crores, and the industry is sort of sluggish. So just trying to understand that, is there something else that we can do in terms of being able to accelerate the growth on the fasteners business? I think a couple of years back we were doing a good amount of exports as well. So is that an option? Just trying to understand.
Sonal, if I can call you Sonal.
Yeah.
Is that right? Am I getting your name correct?
Yeah.
Okay. Sonal, a good question. I think our objective is to grow faster than industry. I think we have some opportunities in our customer acquisition strategy, in our product acquisition strategy, which we are working on and which are already bearing results. Hopefully, they will show some positive impact in FY25. So, if you see our customer portfolio, if we talk about passenger vehicles, we work very closely with Maruti Suzuki and also in Mahindra Automotive Division. One large customer which we have just activated this year after years of work with them is the Hyundai Kia Group, and they're the second largest manufacturer in India after Maruti Suzuki. They've become a very dominant force in Indian passenger vehicle space. We are hopeful that we convert that customer to much larger revenues in years going forward. So, despite the fact the industry may not grow, we hope to grow faster in the passenger vehicle segment. Also, in our two-wheeler space, we work very closely with Honda and Suzuki motorcycles. Hero we reactivated last year, we hope to grow faster than the industry in that segment as well. So we have a couple of strategies we are working on in terms of customer acquisition and product acquisition, which will help us grow faster than the industry. We believe the industry will be industry will not grow as fast as in the last 2-3 years. It's kind of cyclical, but we at Sterling hope that we hope to grow much faster than that.
And sorry, just on the export front, I mean, like, is that an option or that was more opportunistic in nature?
No, I think that's an option. We are currently in negotiation with some large tier 1 customers on that. But on export cycles, this work takes years of work. The customers we were working in Europe with pre-COVID, somehow they had a turbulent time. They came under financial stress, and they were not able to continue their business model at a higher volume we were working at. So they have rationalized their businesses, but we at the same time looking at acquiring more customers. But having said that, that is definitely a weak area in our customer portfolio, which we're working on, but the visibility is still very slow on that.
Got it. And just my last question on the EV side, I mean, when are we anticipating really the pickup on the three-wheelers and LCV side, right? Like any time frame?
This is Jaideep. So three-wheelers already we do decent volumes. I'm just going to see if I can find. So I mean, three-wheelers is something I think we've got 5 customers which are on active production. And as three-wheelers pick up, we will definitely see our numbers pick up. On the LCVs, we expect the actual product launches from our customers to start in let's say the first year of calendar 24 or the first quarter of calendar 24 or first calendar of FY25. So in those 2 quarters, so that's when they will pick up. I don't want to bore you with details, but the three-wheeler industry was one that is one, and I won't say was, is one that we expected to see the highest penetration of electrification because of the payback or the total cost of ownership that is there. It's interesting that there are certain interesting twists that are there. For instance, people rent the passenger three-wheelers. And when they rent them, they drive them 24 hours. So, a person drives it, then his brother drives it, or his friend drives it. So he drives it 12 hours, and his friend drives it 12 hours. That leaves no time for charging. So the industry is adapting to that. So, I think now the numbers are picking up. They're doing better. I was very intrigued to see recently the charging stations that the government has set up actually being used because, for the longest time, there's been very little utilization of them. And the vehicles that were standing there were three-wheelers. So I think the three-wheeler industry is now really ripe for electrification, and we will do very well with that.
Got it. Great. Thanks a lot for taking my question. Thank you.
Thank you. The next question is from the line of Priyank Parekh from Abacus Asset Managers LLP. Please go ahead.
Yeah, thanks for the opportunity. Am I audible?
Yes, please.
Yes, sir.
Yeah, thanks. So just wanted to understand the competitive intensity of this MCU business. So how fragmented this business is, and how like OEMs approach this business? Like, are they having in-house manufacturing also apart from the external suppliers, or how it is?
So it's an evolving landscape. Right now, I can kind of go down the list of the companies and you'll see difference. So TVS currently uses a Bosch motor control unit or Bosch powertrain solution, Bajaj has one which is manufactured by one of their strong tier ones for them. Ather makes in-house and Ola buys from us, just as an example of the four. So the four big boys have all four different strategies around this. In the three-wheeler space, again, you've got the same thing. You've got a couple who make in-house. I mean, Altigreen, I think, is probably the most notable in-house producer. Most of the other companies are buying from outside. In the LCV space, or in the passenger vehicle space, no one is making in-house. Everyone is buying from outside. When you talk about competitive intensity, there are numerous companies that are out there. The question is, there are only a handful that are actually being able to produce any volumes and that have the ecosystem to be able to ramp up supplies and meet customer requirements. So if you go through again the two-wheeler, three-wheeler, and four-wheeler, both light commercial vehicle and passenger vehicle, or if you add heavy commercial vehicle, is that the total number of companies that you'll come up with would be, I would say, about 10 or maybe less than 10 supplying the entire requirement or bulk of the requirement. There may be 20 other companies out there who are doing a few hundreds a month. So there is, I think there is a preference from the industry on certain brands and certain products, but it's a constantly evolving space.
Okay, thanks. So, and another question is there any kind of synergy between our fastener business and the MCU business? Of course, we are catering to kind of similar industry, but apart from that, at a technical level, is there any kind of synergy between these two businesses?
Okay, so at the technical level, you couldn't find something which is further apart, and that's why we keep the businesses absolutely separate. Separate facilities, separate management. There is absolutely no interplay between the two businesses on that technical level. But let's be honest, the most difficult thing about any business is getting customers. That is the most difficult part about business. It's never about producing something or even the technology. Those things are manageable. Getting the customer is really tough. So the fact that we had the foundation of Sterling Tools, so when we made a call to a customer, they knew who Sterling was. There was a certain credibility that went with the name, and we were able to get the businesses because the customers said, well, they were willing to talk to us. I can tell you that there'll be startups with good products that won't be able to get an appointment with an OEM. So the short answer is the synergies on the customer side, but that's the most important synergy.
Okay. Yeah. Okay. Thank you. That's it from my side.
Thank you. We'll take the next question from the line of Saurabh from Multi-Act. Please go ahead.
Yeah, thanks for the opportunity. This is Rahul Picha from Multi-Act. So I have two questions. First is on Ola's second generation platform. What we have read is that they have designed an integrated motor and motor control unit. So wanted to just understand from you whether, our arrangements with them change on this second generation or, our business stays intact, or is there any change in our arrangements?
Look, let me just say we are 100% of Ola business right now. I cannot get into individual models and what goes into that. That would be really treading the line on confidentiality, but we are 100% as of today.
Okay. So our perspective was to just understand from a risk point of view, because we are largely dependent on one customer in the electric vehicle segment right now. So
I would beg to disagree. We are not large. Ola is our biggest customer, but we are not only dependent on them. I think Ola has talked about manufacturing MCUs in-house.
I think in the long term, we see that it's going to be very difficult for companies to cater to the kind of model that they want to do with in-house production. As of today, Ola itself has the S1. Just go back to the last slide. Yeah. So they have the Ola S1, the S1 Pro, the S1 Air, S1X, S1X Plus, right? That's 6 models or 5 models that they have. For them to make 5 different MCUs, 5 different motors, it becomes very challenging also. And the same thing is true now, is going to be true of everyone else. Ather for today, example today, has essentially the 450 platform. But when they launch new models, I mean, will they continue to develop? Because if they continue to develop all the electronics and all of the components themselves, I think that will really slow down the pace. So we think that volumes will continue to increase. And while, yes, there has been talk of Ola. Let me put it this way. Ola has the capability. They're a very strong technology company. They have the capability to make the MCU. The question is that their priority? And you've seen the videos, etc. But the question is that their priority, or is their priority launching vehicles?
Right, got it. So my second question was that I was going through a news report in which it was mentioned that, now we have signed a similar bulk supply contract deal with another two-wheeler OEM like we have with Ola. So can you talk about that?
Well, no, we've got of our. I'll just give me 1 minute. 1, 2, 3, 4. So we have 4 two-wheeler contracts.
Right.
So it's not only one, but we have 4 of them, 4 different companies. Sorry, 5. Yeah, 5. My colleague just corrected me. We have 5 different contracts from two-wheeler companies. But all, each one has different volumes and ramping up in a different way.
Right. So what the news report mentioned was that this perhaps this two-wheeler OEM is a large player in the industry. So just wanted some update on that, because right now, other than Ola, the players that we are working with are not very significant in terms of volume.
Look, so I mean, I think let me. When we try and put resources behind, and the biggest constraint for us is engineering resources always. When we put engineering resources into a program, we obviously are doing that basis an assessment of the potential success of the customer. So the customers that we have are, there's Ola and one other customer are large and have reasonable large or reasonable volumes. The other 3 are startups where we believe that the product is good and that they will do well, but the volumes are not as significant.
Got it. Thank you.
Thank you.
Thank you. We'll take the next question from the line of Karthikeyan from Suyash Advisor. Please go ahead.
Yeah, good morning, sir. Just continuing on the previous topic, previous question that was asked, just trying to understand in terms of resizing of the motor and motor control units, how much of the help comes directly from GTEC and how much of it is being done in-house? And how easily are you able to do this? Is the resizing a substantial component?
Okay, so I'll answer this in 2 ways. The resizing basically started as soon as the government unexpectedly changed the FAME guidelines. But we actually had been anticipating, just from hearing, what the market needs were. We'd actually been working on that from a little bit earlier than that. And a lot of the development, we did all of the voice of customer and
management around getting the specs right. A lot of the design work was done in China for the current models that we are talking about. We, however, have our own we have also developed our own capability, in-house capability to design motor control units between our engineering centers in Delhi and Bangalore, and future models will be designed in India. I hope that answers your question.
Yes, I just wanted to understand if you have to give me some context, by how much does the size shrink, for example? And when I use the word size, I mean it in a very broad context. It could be in terms of value, it could be in terms of other.
I'll just throw out a number which I hope covers, size, cost, price, all of those broadly, about a third. So what we are, basically we are downsizing the product by power rating, size, everything by about a third.
About a third, okay. So, third would be proportional, I'm assuming, right? It wouldn't be different from a price point of view.
That's something it's very difficult to get into. The thing, I think a third would kind of cover everything that we are talking about. That's a good round number to work with.
Fair. And the other thing is with regard to revenue mix across customer categories. So, last we spoke, you talked about how half of your revenues come from non-two-wheelers, shall I say, Ola, from FY25 onwards. Do you believe that that's possible now, or do you believe the timelines can be stretched somewhat?
No, I think the timelines would change a little bit because the industry is evolving, models, the launches are not necessarily going as planned, etc. So no, I don't think we'll be at 50% in FY25.
Fair. Thanks for answering, sir, and best wishes.
Thank you.
Thank you. We'll take the next question from the line of Ruchi Gupta from Value Create Consultants. Please go ahead.
Good morning, sir.
Ma'am, your audio is too low. I would request you to kindly use your...
Hi, good morning.
Yes, ma'am, this is fine.
Yes. So, what will be our steady state ROC for both of our businesses?
So, Pankaj, we think it's going to be 15 to 20%.
On a consolidated level.
On a consolidated level, with fasteners being lower and our subsidiary being higher.
Okay, sir, all right. My second question is, what was the capex we have done over the last 2-3 years for both of our businesses, and what is the capex plan for next 2 years?
Okay, I got to tell you, the second question is very difficult to answer because we've got so many moving pieces that I think maybe it'll be another 3 months before we can lock down what the capex plan is for the next couple of years. I think so. Go ahead, Atul.
Yeah, so the capex plan for this year on a consolidated level is 50 crores plus. We are on track to do that investment this year. We are working on the plan for FY25 as we speak. But like I said, there's so many things which are dynamic and moving. Bulk of the investments will come in our new businesses. On the standalone business, it's probably going to be maintenance capex. But we'll keep you posted once we have final number for the year FY25, FY26.
Okay, sir. Thank you. That's helpful. Thank you.
Thank you. Participants who wishes to ask questions may please press star and 1. We'll take the next question from the line of CA Nihar Shah from Crown Capital. Please go ahead.
Thank you for taking my question again. One small question.
Sorry to interrupt.
Sorry.
Your audio is not clear.
Yeah.
Sir, your voice is breaking.
Hello, sir. Am I audible now?
Yes,
please. That's very good.
Yeah.
Thank you.
Yeah. I was just saying, I heard that we have partnered with Hyundai Kia Group and looking forward to grow faster than the industry. So can you put a number on the console top line, like what number can we achieve? Like in case of percentages, we'll also do like a ballpark number for 25, 26.
Nihar, it's very early for me to give you guidance on that. These are numbers which are very fluid right now, depending on, and they keep on getting complemented, or they keep on increasing on depending on the products we keep on acquiring from the customer. So it's early days for me to give you a number as to what we are looking at in FY25-26.
So can we have a guidance for H2 at least, like H2 guidance for the top line?
I think we maintain the run rate we have right now, or maybe marginally better than that.
Okay. And one small question on EBITDA margins. Like we said on the last Concall, it would be around 15% plus. But right now we are sitting on 12.5% on console basis. So are we in line to achieve the 15% margin, or has there been any change?
So Nihar, one correction, I think at 12.5% margin is on a consolidated level. We never said that the consolidated numbers will go up to 15%. We talked about the standalone business, and we are still very hopeful that we will be very close to that. If the industry was growing faster than it is currently, then I would have given you a little more confident guidance on that particular number, but that's where we are right now on standalone and on a consolidated level.
Okay, no problem. Thank you, and all the best.
Thank you.
Thank you. Ladies and gentlemen, as there are no further questions from the participants, I now hand the conference over to Mr. Atul Agarwal for closing comments. Over to you, sir.
Thank you, everybody, for being patient and taking our time to spend the morning with us today. We will see you again once we announce the third quarter results, and hopefully some of you will reach out for any clarificatory questions or queries you may have post our call today. Please reach out to Pankaj or me or Jerry. We'll hopefully address them for you. Once again, all the best with festival greetings, happy holidays, and wish you good health and prosperity in the coming Diwali days.
Thank you, members of the management. Ladies and gentlemen, on behalf of Sterling Tools Limited, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.
Thanks.